it does really feel like there are a lot of a confluence of negative factors at the moment building. What's most worrying to you, and how are you changing your strategy to best prepare?
Yeah, so, we've been hearing a lot about the strong consumer and robust data coming out regarding the consumer. We saw stronger PMIs today. But we think more importantly, investors need to keep their eyes on the high frequency data, and that is rolling over fast. Consumer purchasing power is starting to weaken. Inflation adjusted wages are declining. We're seeing layoffs just starting to rise, and manufacturing resilience, we think, will also be tested as consumers move away from goods towards services like entertainment and travel. So we do think that we're on the cusp of what we think is a turning point where the data is still coming in pretty strong, but the high frequency data, as I said, is starting to roll over. So we do see a rising probability of a recession in the second half of this year, potentially persisting into 2023 as the Fed continues to battle inflation.
Of course, the other thing that we're contending with, which, to be fair, has been very well flagged and should be expected, is the balance sheet runoff. Take a look at this chart, though, in terms of what the New York Fed is expecting that to look like. They're projecting the balance sheet will fall by an average of $80 billion per month through 2024. It's a milestone for sure. How much has this truly been priced in, or do you expect that still to have an impact?
Yeah, so we do think it's still going to have an impact. We do think that the expectation right now for a 50 basis point increase in June and a 50 basis point increase in July is probably already in markets. But the impact of quantitative tightening starting to roll off the Fed's balance sheet this month is really untested and unprecedented. We did have one short period back in 2018 where the Fed started rolling assets off its balance sheet, but that was quickly halted. So we don't really have a good precedent for this. So our guess is that it's probably not fully priced into markets.
So, Tracie, with all of that uncertainty here in the U.S., where do you go globally? As this chart on the Bloomberg also showing how global earnings estimates have already been revised down. And just this morning, we heard from Citi analysts that we could see even more cuts.
Yeah, that is correct, and we think that the worst of this downturn, this market correction globally, is probably not over yet. So if we're right and we are headed into a recession and a bear market, then we could see more downside this year before we potentially start to climb out of the downturn. Possibly by the end of the year. We are favoring U.S. over international. So we really are moving our assets towards those higher quality areas of the market, like large caps and mid caps, within sectors, healthcare, information technology, energy. Those are our favorites, and we're underweight developed markets and emerging markets. Yep.